that there's very clearly been a rise in retail participation, which curiously enough has offset the selling by institutional investors. So if you look at the emerging Asia daily stock exchange level data, we can see that FIIs, foreign institutional investors, have net sold about $60 billion from the peak of the markets on January 17th until today. And that's the second greatest outflow that we've seen for the full data series going back over 20 years, with the greatest amount of outflow being in the global financial crisis. So, we've seen a significant amount of foreign investors selling. Now, weighing against that, as I just said, is the increased involvement of retail investors. And we're really seeing that gain momentum. It's been most prevalent in Korea, but it's starting to pick up in China, for example. We saw a 7% rise, particularly in the A-share market last week. So the retail investors are really carrying the torch right now for markets. And we think that that can persist for some time to come. That being said, there clearly is risk that if the sentiment changes, that markets which are currently elevated in valuation terms can indeed correct. And that's kind of why we have this sort of short-term positive, but intermediate term, somewhat more conservative view for markets overall.
All right. Timothy, we highlighted the news about SMIC looking to get listed on Shanghai's tech board earlier this morning in our headlines. Out of all the sectors that you like in this part of the world, you are looking at old tech and new tech as well. And I want to understand, how do you compare old tech versus new tech from a value versus return perspective?
So I think that the way to think about that is that the new tech, which is sort of a shorthand term for a lot of the, I guess, digitally driven delivery of goods and services, but particularly from a software perspective, that is something which has clear structural drivers behind it, which have, if anything, been intensified by the whole COVID crisis and the movement towards stay at home, and the fact that that's tipped a lot of people into greater acceptance of and usage of the digital delivery of goods and services. So that's a very clear structural trend, and one that's been manifested in the stocks going up in a very clear and trended manner. Valuations have indeed expanded there, so I think that's the area we need to be mindful of. In contrast, though, what you might call old tech, which I guess we would have as more tech hardware, semiconductors, et cetera, that's clearly much more cyclical, but we think does have some clear drivers and thematic proponents to it, specifically the theme of 5G adoption, the densification of electronics in automobiles, the Internet of Things, the build out of cloud services, et cetera. So these are ones that have both a macroeconomic sensitivity as well as some sector-specific drivers to them. And valuations are typically lower. They're also lower for Asia compared to the other parts of the world. So we do think that there are clear reasons for favoring these sectors. I think also the last point I'd make is particularly for China, where one of the manifestations of U.S. and China tension, particularly along the technology front, is China making greater efforts to be more self-sufficient, and that's clearly being manifested in the semiconductor space with SMIC, as you just questioned.